Good morning from our global headquarters in New York. I'm Danny Berger. Manish Krani is off today. Welcome to Bloomberg Brief. Let's set your agenda. Jobs Day in America, Doge cuts and growth scares pull the focus onto the 8:30 a.m. data release. Two-faced and evil. China denounces President Trump's tariffs. Trump, meanwhile, announces a delay for Canada and Mexico. And a bright spot in a struggling equity market. Broadcom surges after its earnings report. Well, it's Jobs Day Friday. Survey expectation is for 160,000. That's off the back of the worst day of 2025 for U.S. equities. The second time this week I've been able to say that superlative, even though Trump announced a delay for USMCA compliant goods until April 2nd. We tried to rally this morning. NASDAQ leads the gains after leading the losses yesterday. That is up 0.5%. By the way, Deutsche Bank pointing out that yesterday was the sixth session in a row that the S&P moved more than 1% in either direction. That is the longest such run since November of 2020, underscoring the volatility. In the bond market, the U.S. Treasuries on the short end, it was a rally. We try to stay with that this morning, though we're flipping back and forth between gains and losses. Little change at 3.9%. We priced in a full 3 Fed cuts by December. Your 10-year yield, that's lower by just about a basis point. Same goes for the long end. 4.26 is where we stand on your 10-year yield. By the way, the euro at 108, it is on track for its best week since 2009. Now, we also have some individual stocks we're keeping an eye on this morning. I mentioned Broadcom. That's helping to lift tech this morning. If it sticks this nearly 13% gain, it would be the biggest gain in 12 weeks. It gave an upbeat forecast, reassured investors that spending on AI computing remains healthy. Gap, that is also soaring in the pre-market trade this morning, up 18.3%. Quarterly sales showed that their CEO, Richard Dixon's turnaround playbook is working. Have you seen what they've been putting on the red carpet? It's been really interesting. It reported better than expected results at its namesake brand, Old Navy and Banana Republic. Finally, wrapping things up with HPE to the downside, down 20.5%. That's the biggest plunge since 2020. If it holds that, it said profit in the coming year would be hurt by tariffs, weak margins on server sales, and execution issues. The company also said that it would eliminate about 3,000 jobs. In just a few moments, we're going to be catching up with Eileen Burbidge of Passion Capital. Later this hour, we will be talking with Citi's Veronica on the Cummings job report. So the S&P 500, it fell to a 4-month low on Thursday. As I mentioned, its worst day of 2025 for the second time this week. Though Trump delayed tariffs, it's still tariff uncertainty keeping markets on edge. And there's some idea, does the market sell-off cause President Trump to move? Well, here's what he had to say.
Some of these temporary delays, have you been influenced in those decisions because of the market reaction?
Well, there are no delays at all. No, nothing to do with the market. I'm not even looking at the market because long term, the United States will be very strong with what's happening here. I think it's globalists that see how rich our country is going to be and they don't like it.
Joining us now, I'm pleased to say, is Eileen Burbidge, founding partner at Passion Capital and executive director at Fertifa. Eileen, it's so great to see you, and I'm so pleased to talk to you about this today because through your different VC adventures, you've worked with so many different entrepreneurs who have to navigate especially difficult business situations. In looking at this now, do you expect that markets can act as a sort of put, that a Trump put can come into place if markets sell off, or do entrepreneurs, do businesses and investors need to adjust to this level of uncertainty?
Thanks so much for having me on, Danny. And I think it's such a great question, and I wish I had a really good, really succinct response for you. Without meaning to sound trite, I really think the best way to weather this is to take uncertainty and volatility in the macro and in the geopolitical sense as business as usual. Entrepreneurs, investors, I think the best that we can do for the sector itself and business overall or commercially is to be heads down focused on driving business execution, delivering performance, thinking about fundamentals, growth opportunities, and try and sort of stay a little bit below the kind of rippling waves, right? And you're seeing the volatility in the markets yesterday and then the surge in after hours. I do think equities investors are looking at reasons to either sell off or to buy in. And so if somebody's building a business, they really need to stay focused on their North Star and what their fundamentals are.
Well, on that point of sort of the volatility in markets, Eileen, is what we're witnessing now, is this some type of growth scare, or is it, and this is very much so the case in private markets as well, that valuations were just frothy and this is a moment of reset?
Yeah, I think you can have all of the above, and those two options aren't mutually exclusive. I think you see a bit of both. I mean, we're seeing volatility and some of these, surges downwards being the worst or the most aggressive since COVID. So we're clearly seeing a very heavy reaction to the uncertainty, to the Trump administration, but also you're potentially seeing a reset from maybe the relief after COVID, and we had a really bullish market in 2021.
Does that mean that there are more opportunities within the volatility, Eileen, or is it that uncertainty that's just going to keep folks on the sideline?
No, always. So I'm an investor. I'm an eternal optimist. I think with challenge, with risk, with volatility, with uncertainty, always opportunity. And we saw that with COVID, of course, in certain ways, while obviously it was a global pandemic and a tragedy in so many ways. For business opportunities, there's always going to be a silver lining. And here with the uncertainty, again, if businesses can focus on the fundamentals or they're looking at growth opportunities, whether that's artificial intelligence or something that's really near and dear to my heart, for instance, healthcare, which is at even greater risk or greater threat right now. So there will be opportunities to bring technology and innovation into industries and sectors which people will forever need to rely on.
To that point, Eileen, how challenging is it to have, again, not just tariffs, but policy coming out of the White House when it comes to things like cuts for different forms of funding, concerns over what Medicare and Medicaid look like? What does the opportunity set look like in the U.S. healthcare sector when you have those worries clouding the overall picture?
Yeah, I think the opportunities are boundless. And in the US, there's always been a challenge with healthcare, and it's always been private payer, and you don't have a sort of socialized medicine to fall back on. I think it's even more apparent, say, outside of the US, where there's often been socialized medicine. So here in the UK, we have the NHS, we have a great public healthcare sector, and you have that across Europe as well. But unfortunately, geopolitical uncertainty, tensions, issues, the need to spend on defense or increase in defense means that public sector spending is going down globally and around the world, which means that we're going to need private sector innovation and new sort of propositions in order to help fill the gap.
I'd say, Eileen, this interesting thing has happened. If you just look back to Davos, the conversation was American executives are so excited. We're entering this booming period of growth. And Europe is the one that's going to be struggling to. Europe is stimulating at the same time that the U.S. is starting to see these growth fractures. For you, has the opportunity set changed? Does Europe all of a sudden look like it's open for business and more attractive with the government? And I realize it means, as you say, less spending on potentially things like healthcare, but just more spending in general.
Yeah, I mean, I think I've always been actually very bullish on the UK and Europe more broadly, and it's why I relocated here and have stayed here for the last 20 plus years. But absolutely, I think for anyone who is discounting the opportunity in Europe or in the UK, that's clearly proving out to be, needless concern. Because as we're seeing, the reaction to what's happening in the US means that people are looking at other opportunities further afield. We see record number of US citizens applying for citizenship or passports outside of the US, coming to the UK potentially, and to Europe. And so it's all very much relative. And I do think, given that there's been a bit of a wake-up call in terms of not just relying on what had traditionally been a really strong trade partner, you're going to see lots more investment across the UK and Europe in all sectors.
I mean, I'm afraid we're going to have to end it there, but it's been far too long. So great to have you on the show this morning. Please join again, Eileen Burbidge of Passion Capital. Let's get you some other stories that are trending on the terminal this morning. President Trump has signed a long-awaited order creating a strategic Bitcoin reserve and an additional stockpile of other digital assets. But the reserve will consist of crypto that the federal government already owns. That fell short of industry expectations, and that has caused Bitcoin to drop, just trading below $89,000 this morning. Goldman Sachs is trying to send more managers to offices outside its main hub. It's an initiative dubbed informally by some as Project Voyage. The push is aiming to drive down costs and tap a pipeline of talent emerging in regions like Dallas and Salt Lake City. Much of the shift has focused on middle and back office roles. Sycamore Partners will be buying Walgreens for $10 billion. That's turning the drugstore private. The purchase price represents an 8% premium to Walgreens' closing price. The deal is expected to close in the fourth quarter of this year. The company's value has declined significantly over the past decade with increased competition and stingier payments from health insurers. Coming up, China's top diplomat blasts President Trump, raising tensions between the world's largest economies. We're going to give you the details next.
Mutual respect is a basic norm governing state-to-state relations. It is also an important prerequisite for China-US relations. No country should fantasize that it can suppress China and maintain good relations with China at the same time. Such two-faced acts are not good for the stability of bilateral relations or for building mutual trust.
That was the Chinese Foreign Minister Wang Yi speaking earlier, representing China as a force for stability as U.S. President Trump shakes up the world economy with tariffs. Joining us for both the China side of the coverage and the U.S., it's Bloomberg's James Mager and Brendan Murray. Great to see you both. James, I want to start with you because not only did we hear from Wang Yi there, we also heard from the foreign minister saying if war is what the U.S. wants, be it a tariff war, a trade war, or any type of war, we're ready to fight until the end. James, this is quite aggressive language.
Yeah, you've seen a real ramp up, I think, this week in comments from the Chinese Foreign Ministry. That was Lin Jian speaking on Tuesday. You just quoted there. You had Foreign Minister Wang Yi speaking today. The embassy in D.C. reprinted or tweeted those comments from Lin Jian on Wednesday. And I think that the Chinese government is clearly trying to make a point to America at this point. It may be it looks like speaking loudly and carrying what's turned out to be quite a small tariff stick is working to force negotiations and talks with the Canadians and the Mexicans. And the Chinese are making the point that this is not working for them. They are not happy about the tariffs that were announced in February and then imposed in February, and then the tariffs were just announced in March and imposed this week. They are not happy about how that has worked out. They are not happy about what the U.S. is doing. And so what Wang Yi was saying today is that you can't have when Donald Trump comes out and says he has a great relationship with Xi Jinping, he'd love to speak to Xi Jinping, and then the U.S. goes and does this, this is not how China works, and this is not what they want to happen, and this is not going to lead to a good relationship or negotiations, which might fix the problems that the U.S. has with China, but also try and fix the problems that China has with the U.S. So I think this week has really been a turning point in at least the rhetoric coming out of Beijing on regarding what the U.S. has done.
Brendan, let me bring you in on that point, because as James mentioned, it seemed that, as he put it, the small stick has worked with Canada and Mexico. How do we evaluate Trump's delay? Because it is just a delay. It is not an ending of tariffs, but it is a delay just for Canada and Mexico and not for China.
Yeah, I think the main lesson we can draw from this week is that tariffs, when applied broadly, are a pretty blunt instrument, and you can create a lot of confusion and chaos among industries that you're trying to help. Let's remember, we started on Tuesday with 25% tariffs on pretty much everything from Canada and Mexico. Then came Wednesday, we got a carve out for the auto industry, and then Thursday we had all trade between the three countries being exempted from the 25% if it complied with the USMCA rules until April 2nd. So we saw the kind of punch in the face, and then the sort of slow sort of step back from the main threat of the full tariffs. And I think one of the messages is that they're aware now in the White House that these tariffs are going to cause economic damage. We're seeing some of that damage appear in the surveys. The two ISM surveys that we saw this year, prices paid indexes are going up. The Beige Book from the Fed had 49 references to tariffs and businesses complaining about tariffs. That was 0 last year at this time, and that number was 0 the year before. So tariffs are definitely becoming a headwind for businesses in the U.S., and the Trump administration is taking note of that.
And it's perhaps a tell that even with that delay for compliant companies, stocks still fell, so there is that uncertainty. But James, one way that that nations are trying to deal with this is shore up their economy. We see it happening in Europe, which I acknowledge is also a response to defense. But China, the same is happening too. What was the outcome in your mind from the NPC and the ability of China to right-size their economy to weather any economic impact coming from American tariffs?
I think the thing to take away from this week was two things. One, the data we saw today is that trade is still a massive driver for Chinese growth. You saw in the first 2 months, in the data we saw today, $540 billion worth of exports just in January and February alone. 75 billion of that was to America. A lot of that is front loading of tariffs, or front loading to get ahead of tariffs. But growth is, exports are still going to be a big driver for the Chinese economy this year, even if Donald Trump does raise tariffs further. And the other thing is China's economy domestically is not doing great. So you saw the government release a pretty bullish 5% growth target. But they also said to achieve that, they're going to have to increase the budget deficit to the largest on record. And so what they're saying is, without extra government spending, without the government borrowing and spending money, they are not going to be able to achieve the growth that they want. And also, you didn't see it, but there's basically no expectation that the Chinese government will be able to drag the economy out of deflation this year. So even with this big ramp up of government spending and the biggest deficit on record, China's economy will still be in deflation this year. So the takeaway from where I sit in Beijing, at least, is that China's economy is not looking great. And if tariffs are ramped up on Chinese goods by the US and possibly by other countries as well, Mexico, Canada have talked about it, the damage to China's economy is going to be even greater. So Beijing may well have to do in the third quarter what it did in the third quarter last year and the year before, which is come out with another stimulus package to try and help the domestic economy.
A lot of moving parts to this. James, Brendan, thank you so much for helping us keep track of it. James Mager and Brendan Murray there. Coming up on the show, Broadcom soars, AI fuels its strong forecast. We're going to discuss the chip company next, up 12.7% in the pre-market. Let's take a look at what's on the front pages this morning. First up, the FT leading with the EU rallying around President Zelensky to pledge more Ukraine aid, the promise of enduring support by all but one of the bloc's leaders, and that would be Hungary's pro-Russia Premier Viktor Orban. He refused to support the statement, and that forced the other 26 leaders to issue a text without him. Next up, just absolutely incredible pictures on the Wall Street Journal. SpaceX launching another Starship rocket, but the spacecraft exploded as it was ascending. The explosion disrupted flights, with aircrafts diverting in parts of the Caribbean, and departures were delayed from Fort Lauderdale, Hollywood, and Miami International airports. The FAA said that it would require SpaceX to conduct an investigation into the explosion's cause. I don't think we have the pictures of the explosion, but some people were tweeting out these photos of the night sky looking like they were lit up. It was really quite striking looking. And Bloomberg leading with this, Broadcom soaring after it reported an upbeat forecast. Those results suggesting that spending on AI computing does indeed remain healthy. Let's get more on this. Joining us now is Kunjan Shobani of Bloomberg Intelligence. Kunjan, great to see you this morning. Look, we had entered this period of this earnings results with some souring sentiment, be it the sell-off in NVIDIA, Broadcom itself, Marvell Technology results the other day. So does Broadcom show us that perhaps some of the souring sentiment isn't necessarily the holistic picture for AI technology right now?
It does, and they exactly hit the right point which investors wanted to see since the DeepSeek, whether this rally can continue and not just in the beat and raises for the next quarter, but for the next 2 years. And that's what exactly they addressed by adding 2 new customers. So there's like 4 additional customers on top of the 3 that they're already shipping. That gives us the confidence that if they get those wins, they'll be showing growth in the AI revenues, not just in 25, 26, but even 27 and beyond.
What represents the strategy for getting those customers and for a Broadcom to be doing better than, say, a Marvell?
Well, Broadcom is the incumbent when it comes to AI networking and AI custom chips. So it's just them showing off their leadership and their strength. It's no surprise. Look, they have had more than 85% share in these areas, and Marvell is the one who's trying to gain share in these areas. They've done great as well, but Broadcom just continues to build on its leadership.
There was also this other idea heading into this earnings report, Kunjan, especially looking at an NVIDIA, that the era of just spectacular growth, of huge upside surprises, that is over, that the earnings still look strong, but the extent of upside surprise wouldn't be as long-lasting as it had been in the past. Again, does Broadcom prove that's not the case, or is that an exception in an otherwise normalizing environment?
Well, this earnings season, Broadcom was an exception because what it did is give the promise of exceptional growth year over year by adding these large customers, or adding the potential of gaining these large customers, I should say. Other thing to keep in mind is the size of NVIDIA and Broadcom are very different when it comes to AI revenue. It's easy to grow a 10, 20 billion AI semiconductor revenues 100, 200%. It's not that easy to grow 100 billion, 200 billion of AI semi revenues every year by that mark.
Kunjan, really great to have you. I know you're usually based in San Francisco, so it's so great to have you in a time zone that we can actually talk to you. Kunjan Shivani of Bloomberg Intelligence, thank you so much. And those shares up more than 12% this morning. Coming up, we're going to count down to the payrolls data. We catch up with Citi's Veronica Clark next. You do not want to miss that conversation. This is your Bloomberg Brief on Jobs Day in America. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Jobs Day in America, Doge cuts and growth scares pull focus onto the 8:30 a.m. data release. Two-faced and evil, China denounces President Trump's tariffs. Trump, meanwhile, announces a delay for Canada and Mexico. And a bright spot in a struggling equity market, Broadcom surges after its earnings report. The survey expectation, 160,000 jobs. That report comes in just about 3 hours' time. It is off the back of the worst day for stocks since 2025, the second time that has happened this week. Even though Trump announced a delay for USMCA compliant goods, it is an uncertainty. And maybe we'll get some more certainty until that delay comes up on April 2nd. We add some weight to the equity market this morning. NASDAQ 100 outperforms. Thanks to Broadcom, strong earnings. We're up nearly 0.5%. By the way, Euro, you see it on the bottom of your screen at 108. It is on track for its best week since 2009, after the ECB and after more spending. Let's look at this Treasury market, because you did see the short end rally yesterday. We take a pause from that this morning, but we still are pricing in 3 full Fed cuts for this year. Your 10-year yield, that is down 1.5 basis points, that at 4.26 this morning. Well, we are less than 3 hours away, actually basically exactly 3 hours away, I should say, from the latest jobs report. We also have Fed Chair Powell. He'll be making remarks at 12:30 p.m. Eastern time. Bloomberg's Enda Curran joins us now from Washington on this. Enda, what are the expectations for the jobs figures today?
Well, it's expected to be a pretty robust print, Danny. Non-farm payroll is expected to come in at plus 160,000 for the month of February, and the unemployment rate staying low at 4%. And that the feeling is that this might be the kind of last true read before we see the impact of the Doge-led cuts on the public sector, on the federal government employees, and of course, as we start to see some signs of weakness in other sectors of the economy, in the private sector. Two, the thinking is, though, that if there is to be a downside today, it might reflect perhaps the hiring freeze that was implemented by the federal government early on. Even if we're not going to see necessarily job losses, we might see much slower jobs growth than anticipated. So that might show through in today's numbers. Also look, by the way, for sectoral analysis. Keep an eye on what's happening in manufacturing, any signs of ongoing pain there due to the tariff imposition, and whether or not there's broad-based weakness starting to appear across the private sector. But either way, regardless, the story today is expected to be February jobs were held up. It's really going to be a case of what the jobs data for the months ahead start to show in terms of how the public spending cuts show up and how any softening in business sentiment shows up.
And Powell's also giving himself the last word before the blackout period. We'll be hearing from him at 2:30 p.m., as I mentioned. Just some of the Fed speak we've gotten, and it seems to be one of holding, of waiting, of seeing what the different policy is going to be. Bostic saying, we'll be surprised if we get a lot of clarity before the late spring into summer. Are we expecting anything different from Powell today?
It's hard to see how the message would be dramatically different, Danny, just because A, things are so fast moving on the policy front, and B, it will take time to become clear just how all of this is impacting. As you say, the Fed officials who have spoken this week, and we have several more speaking today, broadly speaking, make the point that, rates are on hold for now. They need to wait and see. But they're also at times warning that they're not fully satisfied where the inflation story is at yet. They don't yet know how tariffs will impact on the economy. We've had something of a whipsaw week, of course, for the manufacturing sector as well. We had tariffs announced and those tariffs being rolled back. It adds to a sense, I think, of confusion for businesses. And in terms of how this impacts for both inflation and growth is unclear. Treasury Secretary Besson yesterday making clear all of this should be seen as transitory. And certainly plenty of economists now are talking about the word transitory, that any inflation impact from tariffs will be short-lived. Of course, the administration says this will drive longer-term gains. So one would expect Fed Chairman Powell today might play something of a holding game, Danny, just because we don't yet know. Maybe too soon to send any early signals. But again, there's that sense that story can hold for now, but every month that goes by, we'll have to move beyond that narrative and start talking about how the economy is responding to these policy changes. Yeah, and Scott Besson, again, doubling down yesterday, saying that access to cheap goods is not the American dream. Enda, thank you so much. That is Bloomberg's Enda Kern waking up for us early in Washington, D.C. Also up here bright and early is Veronica Clark, U.S. economist at Citi. Veronica, always a pleasure to see you, especially on a jobs day. Yes. There's no one else you'd rather start the day with.
I like coming here on Jobs Fridays.
Good, because we'll keep having you back. So 160 is the survey, the average analyst survey from Bloomberg of economists. What are your expectations for today?
We're a bit on the lower end, so 135,000 payrolls. Think that we might see the unemployment rate tick up to 4.1%. But 135,000, that's still healthy. 4.1% unemployment still within the range it's been in for the last 6 or 7 months. But I do think the risks are pretty two-sided for this one. If we do see weakness, that's obviously going to be a much more concerning sign headed into the latter half of the month, start of March. Which is when we've gotten this shift in sentiment, tariffs, building, the Doge layoffs. We'll start to see that in later months. So this February reading could look a bit stale in a sense.
So, okay, February reading looks a bit stale, but is there a figure that shifts the Fed from talking about its uncertainty, we have to wait and see, we don't know what the policy is, to, oh no, there's actual weakness and cuts need to seriously be considered sooner?
I think on this one print alone, probably not. Certainly if we saw something below 100K, if we happen to see job loss in February, obviously that's going to get a lot more concerning because we are getting into months where we would expect to see even more weakness. It's not going to necessarily show up in February. It's really the later months that are potentially even weaker.
Well, on that, some of the higher frequency data, we had the Challengers report earlier this week, the ADP, both did not look great. What does that tell you about where we're headed and the impact of Doge in the numbers?
Yeah, absolutely. That Challenger number yesterday was interesting. It did include some of those Doge layoffs, so that's really just tracking headlines like we would. We know that those will probably show up later. Job cut announcements, even excluding the government, though, were relatively elevated. We've seen initial jobless claims for the most part are still low and healthy. We had a reading about a week ago that was maybe a bit higher. We're obviously watching that weekly data. But I do think, as we're getting into the spring and summer, we have been seeing weakness in the labor market for a while already. It's really the spring and summer where you would expect businesses to pick up hiring. And this uncertainty maybe means they don't.
Well, there has been a vibe shift in this wider market. But again, you've been flagging some of the underlying weakness. When you look at the vibe shift, is it more the economy is already weak and people are finally waking up to that? Or is an economy that's getting weaker because of policy coming out of the White House?
Yeah, I mean, I do think, restrictive rates have led us to this point partly. That's why hiring has been so low. That's why we've seen weakness already in manufacturing and housing. Obviously, the consumer has been holding up pretty well, but savings rates are low and delinquencies are high. And what happens when rates are restrictive is that you can get a shock, maybe like government policy changes, that the economy is not as well positioned to handle if rates were lower. And that could be what causes this sharper slowdown.
It's interesting you say that because Neil Dutta at Renmac has kind of a similar take, and he talks about this feedback loop, saying that essentially you have restrictive rates, the economy looks weak, but you have a Fed that's not doing anything because they don't know where policy is going to go. Is that a big concern for you right now, that you could have them staying with rates restrictive because they're just waiting to get some sort of clarity from the White House?
Yeah, in a way. I mean, I think they will obviously have to weigh the inflation side of things. And we do know that tariffs mechanically will probably show up in higher consumer prices. I think they'll be waiting to see that, it's the stag part of the stagflation concerns that maybe, takes precedent. Because if the labor market is weakening, we wouldn't expect that businesses can pass on higher prices as much as they might otherwise, and I think they'll be more concerned on the labor market once we see that data.
There has been, I mean, not outright, but like a little bit of creeping of people talking about recession. David Solomon had mentioned it at a conference, saying it's not likely to happen, but it's now a possibility. The Barclays team saying something too. Are we going to have a 2025 where we start talking about a recession again?
We could. It's, I think we would still assign it a lot higher probability than others would. It's not in our official baseline anymore, but we do have essentially flat growth by the middle of the year. Some of this GDP data obviously is going to be skewed by, big shifts in imports and inventories and things like that. That's what we're seeing in the Atlanta Fed GDP now, right now. But if you look at final private domestic demand, I think that's slowing also. Consumers pulling back on spending, businesses pulling back on investment.
And say, what's changed for the consumer? Because this has been the thing that's really held up. That spending has looked really robust, but some of the numbers have started to look weaker.
Yeah, I wouldn't read necessarily so much into that very weak January. Obviously, it was coming off of December that was strong, Q4 that was strong. There's seasonal adjustment, weather issues potentially, but I do think savings rates have been low for a while. Consumer delinquencies have been high. Certainly, higher income consumers have been feeling the wealth effect of equities going up, and now that is not necessarily the case. And if you are getting more worried about losing your job, if you're a federal worker, even if you're not being laid off, I can imagine that you're saving more and you're pulling back on spending. And it's things like that that can have these bigger ripple effects.
So I was looking at this Bank of America credit card data, basically saying consumer spending picked up nationally last week, but it fell in one place, and it probably won't surprise you. It fell in Washington, D.C.
Interesting.
if there is a sort of D.C. area, let's call it mini recession, D.C., Northern Virginia, Southern Maryland, can the rest of the nation survive that, or will it have ramifications more broadly?
Yeah, I certainly would be worried about some more spillover. Also, just because the federal government, obviously located in D.C., but has employees across the country and is a really big employer. Especially add on, government contractors. That's the harder to estimate size impact for us. Is what will the spillover be? And yeah, I would think that there could be some ripple effects.
Well, we certainly live in interesting times.
Yes.
Veronica, thank you so much for joining. Always a pleasure to have you on. That is Citi's Veronica Clark. Okay, let's get a quick check on your markets this morning. S&P 500 futures climbing back after their worst day so far of the year. We're up about 1/3%. The Bloomberg dollar spot, that is weakening. We have a euro on track for its best week since 2009 after an ECB that seemed to cool it on the cuts to come and more spending out of Europe. Your 10-year yield at 4.26 this morning. And a check on crypto. Bitcoin falling below 90,000. We had an executive order on a strategic crypto reserve. However, the key quote from that, the government will not acquire additional assets for the stockpile beyond those obtained through forfeiture proceedings. There was a hope that they would be buying more. Does not seem to be so. Coming up, Walgreens set to go private in a deal valued at $10 billion. Are LBOs, the monster LBOs, back? We're going to break it down for you on your Bloomberg Brief. It's your Bloomberg Brief. Danny Berger here in New York. One of the largest drugstores in the U.S. is going private. Walgreens set to be purchased by Sycamore Partners. The deal would value them at $10 billion. Sycamore, for their part, will pay $11.45 a share in cash for the retailer. Joining us now is Bloomberg's Claire Rutkin. Claire, this is a big deal. In a year that seems like M&A has more or less paused, are the mega leverage buyouts, are they back?
Let's hope so. I mean, this is one of the largest leverage buyouts since the great financial crisis. So it's definitely positive news that it's happening. Everyone's been talking about the return of M&A since the end of 23. It didn't happen. It didn't happen last year. And you can see where I'm going with this. 2025 was supposed to be the return of M&A. It's been a pretty lackluster start to the year so far. People have been looking at Walgreens boots, saying, is it going to happen? Is it not? Sycamore's been around it for a few months. I think people were feeling a bit like downbeat about it. So the fact that it's happening is positive. And that could also lead to other deals happening later this year.
Can we talk about the structure of this deal, Claire? Because as you mentioned, it's one of the biggest deals post-financial crisis. But the environment for funding debt has really changed since then with the rise of private credit. So what did this one actually look like to get that financing?
Yeah, it's quite an unusual structure. We've seen it a couple of times before, but it's pretty rare. The buyout's going to be backed with around $12 billion of debt financing, $12 billion. And that's going to come from a mix of traditional bank financing, where they underwrite it and they sell it on to institutional investors, and also private credit. Traditionally, we've seen private credit and banks compete in order to finance acquisitions. This time, they're going to work together. So of the $12 billion of debt funding, about $4.5 billion of that is going to come from private credit. But it's not just traditional private credit funds as we know them, like HPS or Ares. You've now got banks like JP Morgan setting aside around $50 billion to invest in private credit deals as well. So there's been a complete blurring of the lines when it comes to financing acquisitions. The debt markets are hot. They're very conducive to M&A, and we can expect them to have quite a bit of fun with this deal.
I was going to say, because there was kind of this narrative of, is it a zero-sum game, that you have all these banks starting to get into private credit, that you have some of them, the banks themselves, maybe partnering with private credit firms themselves. And Claire, that brings us to this whole narrative of public and private markets are converging, that the lines are blurring. Does this deal get us a little bit closer there, that some of the distinguishing factors, maybe not between the types of deals, but the people who do them, is starting to get a little bit more complicated?
Yeah, it's definitely getting complicated. There's a huge blurring of the lines. There's just been so much fundraising, be it into your normal credit funds and your collateral loan obligation vehicles, which are like the biggest buyers of leverage loans, as well as private credit. There's all this money. It wants to put money towards deals. They're all fighting to compete for deals. And when you get a massive buyout like Walgreens Boots that's asking for $12 billion of debt, there's something for everyone here. They can all play. They can all get involved, and it will be interesting to see where pricing comes on a deal like this, because it's really going to tap into like capacity of every market, and we're really going to see this as a huge benchmark deal as to what can be done later on in the year if this happens. This could be the new way forward to finance large-scale M&A.
Well, Claire, looking forward to more of your reporting on it. Bloomberg's Claire Rutkin there. Thank you so much for joining us. Elsewhere in tech, let's get a check on Broadcom shares in the pre-market, because it is extending its double-digit surge, up 12.4%. That is the most in 12 weeks, after giving an upbeat forecast driven by strong AI growth. Kunjan Shabani of Bloomberg Intelligence is now with us for more. Kunjan, it was sour sentiment going into this earnings report for AI players. Does Broadcom defy the gloom?
It does. I mean, it does address the key question everyone's been looking for since the DeepSeek drama, that can the AI semis rally continue, not just this year, but beyond this year. And then they address that by one key point, adding 2 new incremental XPU hyperscale customers. So that brings to 4 new customers that they are engaged with. And if they win that design wins, that means their AI semiconductor revenue can grow 25, 26, and even in 27.
Just going back to what shall ever live in infamy as DeepSeek Monday, there were a lot of questions as to whether earnings from NVIDIA Broadcom, whether any of them would reflect, or at least from executive comments, about what the future would look like and whether there would be less demand for things like data centers. Kunjan, it doesn't feel like we've gotten that. Did DeepSeek change anything for these U.S. AI players?
At this point, no, and it's too soon to say. We don't see any real data points that suggest that demand in 25 or 26 for the U.S. semiconductor players is changing. So this seems more of a qualitative sort of sentimental perspective that in the long term, DeepSeek could kill the demand for this. Again, we have not seen any data point yet, and I think it's too soon to speculate that.
So is the motto for the hyperscalers, Kunjan, then that overinvesting, that underinvesting is the greater risk than overinvesting?
That's how it seems like. I mean, until 6 months ago, we would not have expected Broadcom to have a total of 7 hyperscalers that they are engaged with. That's a pretty big number of players doing their own chips, but here we are. So the trend definitely is showing that the hyperscalers are worried that they might be underinvesting.
Can I just get your thoughts on that, Kunjan? Because I was talking to a private equity executive the other day who said to me that we're going to look back at this period in 5 years from now and say, wow, we have a lot of overcapacity, that too many data centers were built out, and we're going to have a lot of investments from, you know, those big sort of funds like the Apollos of the world that just went too far. Do you think that that is a risk, just because things are evolving so rapidly and we don't know what the technology and what the use cases are going to look like in 5 years' time?
I mean, look, there's definitely could be that risk. I mean, we saw the similar thing play out in the internet and the cloud era. You know, after the initial phase of ramp up of capacity in cloud, we realized, okay, we have a little bit of too much capacity. But when you look at that in terms of a larger time horizon, 5 to 10 years for a new technology inflection, at the end of it, you know, we continued to invest. The investment didn't stop. The cloud capacity continued to increase when you look at it from a 5-10 year era. So I would not get bogged down into like a year or 2 year of digestion. You might end up with a period where you have a little bit of overcapacity, but as long as we are progressing in the right direction, it would all even out.
Kunjan, really wonderful to get your thoughts this morning. Thank you for joining us. Kunjan Shobhani of Bloomberg Intelligence. Coming up on the show, it's a big day for markets on this Friday. It is the payrolls report, Chair Powell's speech. Ahead of the blackout period, Powell gets his final word. All of that coming up on your day ahead next. This is Bloomberg Brief.
As it relates to the U.S., it's just so regrettable. It's not really adding efficiency to our operations and not adding efficiency to our customer operations. So we gain new business. We do more customs filings, for instance, so it's not necessarily bad for us. But I think overall, these disruptions are not good for the economic development and the building of wealth.
DHL, just one of the latest companies to express concern, uncertainty over what to do over American tariffs. And we had U.S. stocks decline yesterday, their worst day since 2025. Even though Trump did announce a delay for USMCA compliant tariffs, we're trying to fight back this morning. S&P 500 futures up about 1/3%. Neil Detta at Renmac writing that it is a tell that you had stocks fall even though Trump backed off some of the tariffs, that maybe the damage is already done or a Fed put is more important than a Trump put at this moment. Okay, let's get you set up for your trading day on your Friday. The main event, February payrolls report, that comes out at 8:30 a.m. Eastern. Fed Chair Powell will be speaking at 12:30 p.m. in New York City before the blackout period. We're also going to have more Fed speak. Bowman, Williams, Kugler, all of those on deck throughout the day. Let's look at some of the individual stocks moving this morning. NVIDIA leading Mag 7 stocks higher. Those shares up 1.5%. That's after Broadcom's upbeat forecast. Those shares also up. Costco extending losses 1.5% after their earnings fell short of expectations. HP Enterprises down nearly 20%. It had weak margins, and they announced plans to cut about 3,000 jobs. Well, that is it for Bloomberg Brief. It is Payrolls Friday. The expectation, 160,000 jobs. That data coming out at 8:30 a.m. in about 2.5 hours' time. And that is it for Bloomberg Brief Surveillance. We'll take things from here. And a happy Friday in a beautiful New York.